These developments partly reflect the aftermath of the ongoing war in Ukraine, the backlash from the numerous sanctions imposed on Russia by major advanced economies, as well as persistent supply chain disruptions in major trading routes. At the same time, the Chinese economy remained confronted with the lingering impact of the COVID-19 pandemic, total lockdown of major cities, significant distortions in property market, and modest inflationary pressures. Consequently, the advanced economy and emerging market economy central banks alike are switching to monetary policy tightening to curb the sharp rise in inflation globally. Even as global output growth recovery moderates, the domestic economy is expected to remain on the current path of recovery through 2022. This is hinged on the continued impact of stimulus by both the monetary and fiscal authorities to support the economy following the outbreak of COVID-19 pandemic, and the committee assessed these developments and the outlook for the rest of the year. 11 members of the committee attended this meeting. The global economic development. The global output commenced a broad slowdown in the first quarter of 2022 as a result of the conflict between Russia and Ukraine, after recovering considerably in 2021. This led to massive supply constraints, with the backlash of sanctions against Russia creating huge macroeconomic imbalances for several countries. Consequently, the uncertainties that have arisen are buoyed by the resumption of the spread of the COVID-19 pandemic in China, a key hub of global manufacturing. This has given rise to upside risks to inflation and downside risks to growth. In addition, the huge amount of stimulus deployed by various countries to ease the downsides of the COVID-19 pandemic, particularly in 2021, has predisposed the global economy to huge debt levels, considering the current burgeoning global private and public debt portfolios. Central banks in both the advanced and emerging market economies have thus commenced monetary policy tightening to curb rising prices. These could impact the recovery negatively and result in a rise in debt default as global financial conditions indeed get tighter. Furthermore, China has also reintroduced constraining measures to mitigate the spread of a new wave of COVID-19 pandemic within its major industrial cities, resulting in a slowdown in production. In the light of these headwinds, the International Monetary Fund (IMF) downgraded its forecast for global output growth for 2022 and 2023 to 3.6% apiece from 4.4% and 3.8% respectively, reflecting the severity of setbacks to the global recovery. Inflation continued to rise unabated across several advanced economies and is projected for healthcare projects under the Healthcare Sector Intervention Facility, bringing the cumulative disbursements to 130.49 billion naira for 126 projects comprising 58 hospitals, 31 pharmaceuticals, and 37 other healthcare services. The bank released a sum of 21 billion under the Export Facilitation Initiative, EFI, for 3 projects in domestic production and value addition of cocoa and sesame seed. This intervention is targeted at further expansion of the economy's non-oil export basket towards improving foreign exchange revenue earnings for the country. To support micro, small, and medium enterprises, the bank disbursed 1.5 billion to 2,718 new projects through the Agribusiness Small and Medium Enterprise Investment Scheme (AXMIS) for activities in fish farming, rice processing, wheat farming, poultry farming, livestock farming, ICT, and tailoring, among others. This brings the cumulative disbursement under the AXMIS to 136.13 billion naira. Under the Micro, Small, and Medium Enterprise Scheme, the bank disbursed 2.7 billion to support youths engaged at various nodes of the agricultural value chain, bringing the total disbursement under this intervention to 98.88 billion naira to 749 MSME projects across the country. In the area of energy and infrastructure, the CBN released 15.71 billion to power sector players, including generating companies and gas companies. Under the Nigerian Bulk Electricity Trading PLC NBET PAF, bringing cumulative disbursement under the facility to 1.3 trillion naira. The sum of 22.67 billion was also released to distribution companies for their operational expenditure and capital expenditure under the Nigerian Electricity Market Stabilization Facility Phase 2. Cumulative disbursement under this scheme currently stands at 251.93 billion naira. Additionally, under the National Mass Metering Program, the bank has disbursed 0.19 billion naira to discos for the procurement of electricity meters, bringing the cumulative disbursement for the procurement and installation of 865,956 electricity meters across the country to 47.82 billion naira. Interventions in the energy and infrastructure are designed to improve investment and develop enabling infrastructure in Nigerian electricity supply industry. Our outlook. The broad outlook for both the global and domestic economies in the medium term remain clouded with uncertainties arising from the lingering war between Russia and Ukraine, the unfolding impact of the extensive sanctions imposed by several countries on Russia, and the downside risks from the continued spread of COVID-19 pandemic. Global growth is thus confronted with significant headwinds, which may derail the current projection further. The persistent rise in inflation is also set to undermine the recovery of output growth due to the associated buildup of uncertainties around the cost of inventory and other production inputs. The rise in global debt is also an unfolding dilemma which policymakers must carefully evaluate and address to avert a near-term global financial crisis. In summary, while global aggregate demand remains strong and growing, the numerous supply-side constraints will continue to undermine the recovery effort, at least in the short to medium term. In the domestic economy, data on key macroeconomic variables indicate that the recovery of output growth will continue, but at a much subdued pace, considering the unfolding domestic and external shocks to our economy. Domestic price development is, however, expected to maintain an upward pressure in the light of the buildup of increased spending related to the 2023 general elections. Consequently, the Nigerian economy is forecast to grow by 3.24% by the CBN estimate, 4.2% Federal Government of Nigeria estimate, and 3.4% IMF estimate. The committee's consideration. At this meeting, the MPC noted the risks confronting the global economy as those associated with not only inflation and prices, but also include risks associated with weakening growth prospects across the world. The committee observed that whereas post-pandemic policy support has remained broadly expansionary, at least from a fiscal standpoint, the sharp rise in inflation across both the advanced and emerging market economies has generated growing concern among central banks as the progressive rise in inflation, driven by rising aggregate demand and wage growth, is putting unsustainable upward pressure on price levels. Consequently, the major central banks such as the US Fed, the Bank of England, European central banks, and the Bank of Canada have provided strong guidance of a progressive shift away from monetary policy accommodation to drive market interest rate upwards, which may ultimately impart capital flows away from emerging market economies. On the other hand, MPC noted that the war between Russia and Ukraine has resulted in significant disruptions to the global supply chain at a time that the global economy is still confronted with downside risks to growth associated with post-COVID-19 pandemic. In addition to this, global trade has been impacted by the series of restrictions imposed by NATO countries and its allies against trade with Russia. This has increasingly fragmented the global economy, imposing huge restraints on the tepid post-pandemic recovery. Only recently, China, US, and South Africa are seeing renewed spike in COVID-19 infections. For instance, the Chinese government recently reintroduced lockdown in major industrial cities to forestall the spread of the pandemic, further disrupting the supply chain crisis. In the view of the MPC, these two risks pose great challenges to rising inflation globally. As for our domestic economy, MPC noted with delight that the GDP grew by 3.11% in the first quarter of 2022 year-on-year, highlighting a steady recovery for the fifth consecutive quarter. Quarter-on-quarter, real GDP grew by 9.36%, a slight moderation from 11.07% during the previous quarter. MPC, however, was concerned about the somewhat aggressive rise in inflation by almost 90 basis points in April of 2022. To dampen the expectation of the inflationary pressure, MPC decided on the need to take a shift from its historically cautious approach on interest rate to a policy rate hike while still adopting an accommodative approach to development finance initiatives that have helped historically the growth of the Nigerian economy and sustained a recovery. MPC is of the view that rates on the development finance initiatives of the CBN should remain at 5% at least till March 2023. Consequently, as regards the decision on whether to hold, tighten, or loosen, MPC feels that loosening in the face of rising policy rates in advanced economies may result in sharp rise in capital outflow and faster dry up of foreign credit lines. MPC also feels that loosening could lead to further liquidity surfeit and inflationary pressures. As to whether to hold, MPC feels that this will strengthen the perception that CBN has abandoned its primary mandate of taming inflation. On the need to tighten, MPC feels compelled that tightening would help moderate the inflationary trade-off from the steady growth recovery so far recorded and improve real GDP. MPC also feels that tightening will help rein in inflation before it assumes a galloping trend, considering the progressive increase in headline inflation month on month, particularly with a sharp 90 basis points increase recorded in April of 2022. Furthermore, MPC feels that tightening would narrow the negative real interest rate margin, improve market sentiment, and restore investors' confidence. Equally, members believe tightening would moderate inflationary pressure, pass through to exchange rate depreciation, and moderate the speed of capital flow reversal, provide incentives for foreign capital inflows, and sustain remittances. Lastly, tightening could moderate government more domestic borrowing as government debt servicing to revenue ratio increased significantly in recent times and threatening debt sustainability. The committee's decision. Members expressed deep concern about the continued uptrend of inflationary pressure. Despite the gradual improvement in output growth, the committee noted that the current rise in inflation may be inimical to growth and thus hinder the full recovery of the Nigerian economy. While MPC identifies several supply-side factors which may be contributing to inflationary pressure, emerging evidence show that money demand pressure is on the rise and is unlikely to abate until the 2020 general elections are over. The dilemma confronting the monetary policy at this meeting, therefore, is how best to drive down domestic prices, in this case inflation, while at the same time continue to support the fragile recovery of the Nigerian economy. In the light of the current circumstance, the committee was of the view that it was confronted with the choice of either to hold all policy parameters constant, to allow previous policy measures continue to support growth, or tighten the stance of policy to curb money demand growth and development of its domestic prices. A losing option would likely result in an increased liquidity surface, rise in inflationary pressure, and further pressure on our exchange rate. The choice of holding, in the view of members, would not only continue to support growth, even though moderately, but will also allow the growth of money's demand to continue at the current pace, leading to the uptick in inflationary pressure. While growth concerns remain paramount to the committee, the persistent uptick in domestic price levels is clearly a downside risk to growth that must be taken on immediately. While it may seem contradictory to raise rates in the face of fragile growth, it is a dilemma that most central banks around the world today are grappling with at this time. Yet, on balance, it is quite clear and compelling that tackling inflation is more urgent in the sequence of policy objectives. In this regard, MPC urged the bank to redouble its efforts at supporting the priority growth-enhancing sectors of the economy, while urging the federal government to do more to provide a safe and secure environment for economic agents to boost activities and eventually stimulate growth. After carefully reviewing the developments of the last 2 months and outlook for both the domestic and global economies, as well as the benefits and downsides of each policy option, the committee decided to raise monetary policy rate, the first in 2.5 years, to rein in the current rise in inflation, as members were of the view that the continued uptrend may adversely impact growth. The bank further reaffirmed its commitment to continue to provide support to priority sectors as the need arises to support growth until the current upward pressure in price development abates. The committee therefore decided by unanimous vote to raise the monetary policy rate. 6 members voted to raise the MPR by 150 basis points, 4 members by 100 basis points, and 1 member by 50 basis points to 13.5%. In summary, MPC voted to 1. Raise MPR to 13%, 2. Retain asymmetric corridor of plus 100 and minus 700 basis points around the MPR, retain the CRR at 27%, but also urged the management to continue to use its discretionary powers to mop up liquidity where they find it, to ensure that we maintain a very tight monetary liquidity in the system. And 4, retain liquidity ratio at 30%. I thank you all for your attention.
Thank you, Governor. And that was the 142 communique of the MPC meeting held 23rd to 24th of May 2022. We will take some questions, but you will observe, gentlemen of the press, that we dropped the time for these MPC from 2 to 12 due to some exigencies. And so I will appeal and also apologize up front that we may not be able to take all of your questions. The same for our friends who are also online. We probably will not be able to take all of your questions. And so keep it simple and straight to the point. Thank you.
Thank you, Director. Good afternoon, Governor and members of the MPC. I just have one question. The historic change to the MPR, first time in 2 years. Why is the MPC deciding to alter the rates now? Is it more of a local environment, or you're following global central banks? Thank you, Governor.
Good
Good afternoon, CBF Governor. My name is Issa Abdullah from New Telegraph newspapers. Nigerians of late have been witnessing acceleration in market price and inflation. What will MPC do to rein in inflation? And secondly, the increase in the lending rates, what impact will it have on GDP?
Governor, members of the committee, my name is Sunday Michael Ogo. I write for Daily Trust. Recently, we learned that JP Morgan had delisted Nigeria from the emerging market list, especially at a time where we need all the dollars available to support our local situation. What is your reaction to this development? Thank you.
Thank you. That's the much we can take. Governor, sir.
Well, thank you very much. I think for me, the easier one will be the issue of JP Morgan, that were delisted. Let me say that contrary to widespread media reports, that Nigeria has not, reports have it that we were delisted or that we were removed from the JP Morgan bond index. And the truth is that that is very untrue. Nigeria is still in the index. We were only reclassified. Nigeria's rating, I would say, was reclassified from overweight to market weight, which is just a mere reclassification of our size in the index, akin to a rating agency changing your outlook from maybe positive to stable. This is basically what has happened. So let me say, I repeat, Nigeria has not been delisted from any JP Morgan bond index. We have the report here, page 10 of it. I won't bore you with it. Those of you can go online and read it. Page 10 was specifically devoted to Nigeria, and it was very, very clear the reason why Nigeria's rating was moved from overweight to just market weight. I don't think it is important for me to say what they said. If you read the report yourself, you will see that it is not as a result of certain failure or failings on the part of the Central Bank of Nigeria. What is important is that, at least one thing that they have said very clearly, is that Nigeria had been left as an overweight country because they felt that as an oil-producing country, accretion to reserve in the midst of an increase in crude price should result in accretion in reserve. And since they are seeing that this is not happening, that is the reason Nigeria's weight has been brought from overweight to market weight. But I think the other details are there in the report. The other questions from Nancy and New Telegraph are basically related to the main reasons for today's meeting. On inflation, MPR, why the central bank decided, after almost about 2.5 years, to change its stance from just being somewhat accommodative by saying that, yes, we want to play soft because we're trying to see a gradual moderation in inflation rates, while at the same time we see to have global rise inflation and price levels. You all would have seen that the price of crude quite unexpectedly has been at above $100 per barrel. In fact, Nigeria's Bonny Light as at yesterday when we started the meeting was about $116 per barrel. And what this means is that the basic what is called the standard pricing indicator, means that, yes, whereas crude prices have gone up per barrel, but at the same time, the cost of refinery and ultimate price of the product at the pump is at the station, the pump price at the station will naturally have gone up. This is a global phenomenon. And I was watching CNN a few days ago, and one of the analysts was talking about an incredible distortion to financial markets in the United States. And I said, yes, well, welcome to a situation whereas inflation is rising to unprecedented levels in the US and other economies, growth is also coming down. And if you must tackle inflation, prices, and at the same time you want growth, then you know that you are faced with some compelling dilemma as to what to do. You like to see inflation come down, but at the same time, you want growth to go up. But to achieve this, you have to take decisions that are in opposite direction. And that brings to bear as to what type of skills do you have you put in place to ensure that you're able to manage these two in a way that you maintain a balance where you say moderation in inflation and at the same time you grow your economy. For the global economy, like I said, we've seen inflation in the US hit 8.3% unprecedented in decades. In the Euro area, we've seen inflation hit 7.4%, in UK 9%, in China to as high as 2.1%, in India about 7.79%. These are price levels that are unprecedented in decades, and that is the reason the global economy, particularly the central banks or monetary policy authorities globally are thinking of that the need for them to confront inflation. And to do this means that a lot of tough decisions had to be taken. For us in Nigeria, you would have observed that in the last 2.5 years, what we have been saying is that we want to pursue a policy of price stability that is conducive to growth. And that's why somehow we have used our development finance intervention facilities, which has actually yielded positive results and helped to drive growth in our economy. We've used that to drive growth, while at the same time we'll try as much as possible to maintain a hold position while looking at the optimal level of liquidity in the industry to be able to moderate inflation at a level that does not hurt the growth and the economy of our country. But with what we have seen globally, either in the area of supply chains, in the area of increase in price of petroleum products and the rest of them, we have seen an aggressive growth in inflation in Nigeria between March and April of 2022. And the forecasts from our statisticians, both in CBN and the MBS, as well as our colleagues in research and monetary policy, is that unless something drastic, some drastic or significant actions are taken, that it may be difficult for us to really rein in inflation if we don't do something immediately. And that's the reason we felt, okay, for monetary policy, like I said, three things. One, use development finance tools to drive growth and see to how you can use those same tools through the granting of facilities at low interest rate, 5%, 10-year loan, 2-year, 10-year loan with 2-year moratorium and single-digit interest rate, to see how you can use that to drive agriculture and manufacturing output to a level where it can even be seen to be positive on prices, thereby moderating prices. That is one. So what do you achieve with both that? You achieve output growth, manufacturing output and agricultural output. Through our various interventions in targeted credit facilities and SMEs, you can boost consumption expenditure and through that boost growth. But by the fact that you are boosting manufacturing and agricultural output, what you find is that we are also positively impacting prices, which also is effectively inflation. That's one approach we thought we should adopt. Another approach we're adopting all along is to see to given the MPC gave management the power to say, listen, use your discretionary power to manage the level of liquidity in the system to a point where you think that it does not hamper, create serious problems for inflation. But with what is happening globally on prices and output, and then we've seen an aggressive, a 90 basis points increase in inflation for us, and with an expectation that it may even further continue at the aggressive rise, meant that we needed to bring into the football field now MPR to further say that we need interest rates to move up, particularly in the non-priority sectors that we are looking at, that there's a need for interest rate to be signaled and a little bit more aggressive, because you would have expected that Ferraz would have done a signaling, but MPC felt that a 150 basis points would be necessary to really show that we want to truly tame inflation and rein it to a level that we think it can begin to reverse rather than continuing to go up. So what are we doing to make sure that this does not affect because of course you will expect that lending rates will go up. Yes, lending rates will go up to the non-priority sectors. We're not going to deny that. But at least to our priority sectors where we remain committed to, MPC has told management, continue your development finance activities at single-digit interest rates for 10 years loan and 2 years moratorium. Whereas what we can call the non-priority ones, if they go up, then we should be able to use that as a basis to see to how we're able to tame inflation to a level that we think is comfortable. I think what is important here is that this decision has been taken because we felt that there may continue in the next couple of months to be an aggressive acceleration in inflation. And we think there is a need to take some drastic action to reverse it. If we're able to see a reversal, perhaps we can begin to see, yeah, we're returning to what we can call the normal periods when we're looking at moderating, using CRR to moderate inflation, and at the same time, using our development finance to really push for growth. It's not an easy task, and I'm sure you can see the way I'm trying to explain it, but I think trying to understand the mindset of monetary policy committee members at this time is very, very important, that we thought we needed to really speak what is true about our economy, about what is happening globally, and then see to how we can make sure that we tame inflation, which is our core mandate, and at the same time we support growth in the other direction so that Nigerians can see prosperity effectively. So I thank you for your attention. Good afternoon again.